You're 26 years old, working your first proper job for maybe 3 years now, and you just checked your bank balance. For the first time in your life, you see 5 lakh rupees sitting there. Not your salary, not money you're about to spend, just 5 lakhs saved. And you're thinking, okay, cool, but now what? Here's the thing most people won't tell you. That moment, that exact moment when you hit 5 lakh rupees in savings, it's not about the money. I mean, it is about the money, but it's about something way bigger that happens in your brain that literally changes how you think about everything financial for the rest of your life. And if you're sitting there thinking, Rohan, 5 lakh rupees, that's not even that much money. Just stick with me because I'm about to show you some data from 2026 that's going to completely change your perspective. My name is Rohan, and I spend way too much time thinking about why Indians are terrible at building wealth despite being excellent at saving money. If you're someone who's been putting aside 10,000 or 15,000 rupees every month thinking, when does this actually start mattering, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, here's what we're going to cover today. First, the actual psychological shift that happens at 5 lakh rupees and why it's different from 1 lakh or 2 lakh rupees. Second, the math that nobody shows you about what this milestone actually means for your financial future. And third, and this is where it gets really interesting, the specific moves you should make the day you hit this number that most people completely miss. And before we get into this, let me just say, if you haven't hit 5 lakh rupees yet, this video is actually more important for you because we're going to reverse engineer exactly how to get there faster than you think. So let's start with something that's going to sound harsh but needs to be said. Most Indians will never save 5 lakh rupees. Period. Now you might be thinking, Rohan, that can't be true. Everyone has at least 5 lakh rupees saved up by the time they're 30 or 35, right? Wrong. According to the latest SBI report from February 2026, India's household savings rate is at 30.2%, which sounds impressive, right? Higher than the global average of 28.2%. But here's what most people don't realize. That's gross savings. The net financial savings rate, which was at a concerning 5.1% of GDP in 2022-2023, has improved to around 6.5% in FY25. But we're still seeing Indians increasingly taking on debt for housing, education, and consumption. Let me put this in perspective with some real numbers from 2026. As of January 2026, India has over 9.92 crore active SIP accounts, about 21.6 crore demat accounts, but only 5.8 crore unique mutual fund investors. See the problem? We have 216 million demat accounts, but only 58 million people actually investing systematically. That means most people opened an account, maybe bought some stocks during the 2020-2021 bull run, and then nothing. And if you dig deeper into the AMFI data, you'll find that the average SIP amount per account is around 3,127 rupees per month as of January 2026. Do the math with me. 3,127 rupees per month for 12 months equals 37,524 rupees per year. Even at this rate, with 12% annual returns through a mutual fund SIP, you'd hit 5 lakh rupees in about 7 to 8 years, not 17. But here's the catch. Most people don't stick with it that long. They stop when the market dips. They pause for emergencies that aren't really emergencies, or they just lose motivation. This is where it gets really interesting. The mutual fund industry's total AUM hit 81.01 lakh crore rupees in January 2026. That's 81 trillion rupees. But here's the shocking part. If you divide that by India's population of about 140 crore people, it comes out to roughly 57,857 rupees per person. And that's total assets under management, including institutional money, not just retail investors. So when I say most Indians will never save 5 lakh rupees, I'm not being dramatic. I'm being brutally realistic based on 2026 data. Now here's what most people don't realize, and this is where it gets really interesting. The reason 5 lakh rupees is such a critical milestone has nothing to do with the number itself and everything to do with what happens in your brain when you see it. There's this concept in behavioral finance called mental accounting. Basically, your brain treats money differently depending on how much of it there is and where it's sitting. When you have 50,000 rupees in your savings account, your brain sees that as emergency money or money I'm saving for something specific. It's not really yours yet in your mind because you're already planning to spend it. But something magical happens when you hit 5 lakh rupees. Your brain starts thinking in terms of growth instead of accumulation. Let me explain with a real example. In January 2026, equity mutual fund inflows were 24,028 crore rupees. And check this out, this was still the 61st consecutive month of positive inflows. Even when the market wasn't performing spectacularly well, people kept investing. Why? Because somewhere along the line, these investors crossed a threshold where they stopped thinking I'm saving money and started thinking my money is working. That threshold for most people is right around 5 lakh rupees. Here's what I mean. When you have 50,000 rupees and it grows by 12% in a year, that's 6,000 rupees. Nice, but not life changing. That's like 1 month's groceries for a family. But when you have 5 lakh rupees and it grows by 12%, that's 60,000 rupees. That's more than a lot of people's monthly salary. That's when you start thinking, wait, my money is making more money than some people working full time? That psychological shift from I'm saving to my money is working is what separates the 94% of Indians who will struggle financially from the 6% who will actually build significant wealth. And here's the part that really messes with people's heads. Once you hit 5 lakh rupees, the next 5 lakh rupees comes way faster than the first. Why? Because of compounding, obviously, but also because your entire relationship with money has changed. You're no longer thinking about buying that new phone or going on that trip. You're thinking, if I invest this bonus, my 5 lakh rupees becomes 7 lakh rupees, and then that 7 lakh rupees generates 84,000 rupees a year in returns. See how the thinking shifts. Look, let me show you the math that nobody talks about, because once you see this, you can't unsee it. Right now, in February 2026, here's what the Indian investment landscape looks like. Bank savings accounts 2.5% to 7.5% depending on the bank. SBI gives 2.50%, small finance banks up to 7%. Fixed deposits around 7% before tax. Nifty 50 returns 10 to 11% expected for 2026 according to major fund houses. Historical equity mutual fund returns 11 to 13% CAGR over 10 plus years. Let's work with a conservative 12% annual return, which is actually very achievable with a simple index fund SIP. As of January 2026, mutual funds hold 16.36 lakh crore rupees in SIP assets alone, and 97% of equity mutual fund schemes delivered positive returns in 2025. So, you've got 5 lakh rupees sitting as a lump sum. Here's what happens with simple annual compounding. Year 1, 5 lakh rupees at 12% equals 5 lakh 60,000 rupees. You made 60,000 rupees literally doing nothing. That's more than the average monthly salary in many Indian cities. Year 2, 5 lakh 60,000 rupees at 12% equals 6 lakh 27,200 rupees. You made 67,200 rupees this year. Notice it's more than last year? That's compounding. Year 3, 6 lakh 27,200 rupees at 12% equals 7 lakh 2,464 rupees. You made 75,264 rupees. Year 5, you're sitting at 8 lakh 81,117 rupees. You made 88,117 rupees that year alone. Year 10, you have 15 lakh 52,924 rupees. Your money has more than tripled. Now here's where it gets really interesting. Let's say you don't just sit on that 5 lakh rupees. Let's say once you hit this milestone, you're motivated enough to add just 10,000 rupees per month through a SIP. With 5 lakh rupees lump sum plus 10,000 rupees monthly SIP at 12% annual returns with monthly compounding on the SIP, Year 5, 17 lakh 25,045 rupees. Year 10, 39 lakh 50,580 rupees. Year 15, 79 lakh 93,703 rupees. Year 20, 1 crore 53 lakh 38,830 rupees. Yes, you read that right. Starting with 5 lakh rupees and adding just 10,000 rupees per month, which is absolutely doable for anyone earning 50,000 rupees plus per month, gets you to more than 1.53 CR in 20 years. But wait, because this is where everyone makes the same mistake. They look at these numbers and think, yeah, but inflation. Fine, let's account for inflation. RBI data shows India's long-term inflation averaging 5 to 6%. Let's be conservative and say 6%. In real terms, adjusted for inflation, that 1.53 crore rupees in 20 years is worth about 47 lakh 83,000 rupees in today's money. Still a massive amount. But here's what most people miss. The real wealth building happens in the first 10 years. If you start at 25 and hit 5 lakh rupees by 28, you'll have over 39.5 lakh rupees by 38. In nominal terms, your 30s become your wealth building decade, not your struggling decade. Now you might be thinking, Rohan, 12% returns, that's optimistic. Is it though? The Nifty 50 has delivered 11 to 13% CAGR historically. Flexi cap funds like Parag Parekh have delivered around 18.5% over 5 years as of 2026. ICICI Prudential Manufacturing Fund about 23% over 5 years. Even in 2025, when the market gave just 5 to 6% returns overall, 97% of equity mutual fund schemes still delivered positive returns. The point is, 12% is not just achievable, it's actually conservative for a long-term equity portfolio. And remember, with monthly compounding, your effective rate becomes even better, around 12.68 XIRR. Here's what most people don't realize about wealth building in India in 2026. The game has completely changed from what our parents' generation experienced. Your parents probably saved in fixed deposits, PPF, maybe some LIC policies. Why? Because back then those actually made sense. FD rates were 10 to 12% and inflation was also high, but these instruments kept pace. But in 2026, here's the reality. SBI FD approximately 7% before tax. After 30% tax, 4.9% effective return. Inflation currently 2.75% but long-term average 5 to 6%. Real return barely positive or negative depending on your tax bracket. You're essentially treading water by keeping it in safe instruments. This is why the smart money in India has moved to equities. And I don't mean buying random stocks based on tips. I mean systematic, disciplined investing through mutual funds. As of 2025, mutual fund equity purchases hit record levels, 4.9 trillion rupees net purchases, up 13% from 2024. But here's the thing, you need a minimum viable corpus to make this work psychologically. When you have 50,000 rupees invested and the market drops 10%, you lose 5,000 rupees. That feels bad, but it's recoverable. When you have 5 lakh rupees invested and the market drops 10%, you lose 50,000 rupees. That's painful. That's where most people panic and sell. But here's what the data from 2026 shows. SIP investors stayed the course. Even when equity inflows moderated to 24,028 crore rupees in January 2026, down from 28,054 crore rupees in December 2025, it was still positive. People didn't panic. Why? Because when you have 5 lakh rupees, you've crossed the psychological threshold where you understand that volatility is not the same as loss. You've seen your portfolio go up and down enough times to know that the long-term trend is upward. This is why 5 lakh rupees is the real starting line. Before this, you're in the warm-up phase. After this, you're actually running the race. Alright, so you've hit 5 lakh rupees or you're close to hitting it. Here's what you should do immediately. And this is where most people completely drop the ball. Move 1, split it into 3 buckets. This is going to sound boring, but it's crucial. Your 5 lakh rupees should not be sitting in one place. Here's the exact allocation. Bucket 1, Emergency Fund 1,50,000 rupees. This stays in a high-yield savings account or liquid fund. As of January 2026, liquid funds saw 30,681 crore rupees inflows and overnight funds saw 46,280 crore rupees inflows. People are finally understanding the importance of liquidity. Small finance banks are offering 7% on savings accounts. That's where this money goes. Bucket 2, Opportunity Fund, 1 lakh rupees. This is your market crash fund. Keep it in a debt fund or FD where you can access it in 1 to 3 days. When the market tanks 15 to 20%, and it will, this is what you deploy, not before. This is patient money. Bucket 3, Growth Fund, 2.5 lakh rupees. This goes into equity mutual funds. Based on 2026 data, I would split this as 40% in a Nifty 50 index fund, low-cost broad market exposure, 30% in a flexi cap fund, Parag Parekh, Axis Blue Chip, etc. 30% in a mid-cap fund, only if you can handle volatility. Why this split? Because in January 2026, flexi cap funds attracted 7,672 crore rupees, still the highest category despite a 23% drop from December. They work. Move to commit to step up SIPs.
Here's what the data shows. The average SIP in India is around 3,127 rupees per month as of January 2026. But do you know what makes the real difference? Stepping up your SIP by 10% every year. Let me show you the math. If you start a 5,000 rupees monthly SIP today and increase it by 10% every year for 20 years at 12% annual returns with monthly compounding, you end up with approximately 98 lakh 46,000 rupees. A flat 5,000 rupees SIP, around 49 lakh 46,000 rupees. That's almost double just by increasing your contribution as your salary increases. And let's be honest, if you're earning 60,000 rupees a month today, you'll probably be earning 1.2 to 1.5 lakh rupees a month in 10 years. But your expenses don't double. Your rent doesn't double. Your food costs don't double. So commit to this now. Whatever SIP a start today, set a calendar reminder to increase it by 10% every year. Most platforms now have auto step-up features. Use them. Move 3. Kill your anchoring bias. This is the most important one and where most people completely mess up. Once you hit 5 lakh rupees, your brain anchors to that number. You check your portfolio and you're at 4 lakh 70,000 rupees, you panic. You're at 5 lakh 30,000 rupees, you feel good. Stop doing this. The market will fluctuate. In 2025, Indian equities deliver just 5 to 6% returns according to Axis Mutual Fund's CEO. Some months you will be up, some months down. But over 10 to 20 years, the trend is clear, up. The data from 2026 shows that investors who stick with SIPs through volatility outperform 90% of people trying to time the market. Nearly 97% of equity mutual fund schemes delivered positive returns in 2025, but most retail investors didn't see those returns because they panicked and sold during corrections. The point is, your goal after hitting 5 lakh rupees is not to monitor it daily. It's to automate everything and check it once a quarter. That's it. The less you look at it, the better you'll do.
Now let me tell you something that's going to make you realize why hitting 5 lakh rupees in your 20s or early 30s is literally one of the most important financial milestones of your life. There's a massive wealth transfer happening in India right now. According to SEBI and AMFI data, retail participation in equity markets has nearly doubled in just 2 years. But here's the interesting part. This isn't primarily happening in metros anymore. Cities beyond Mumbai, Delhi, Bangalore now account for nearly one-fifth of total mutual fund investments. Small town India is waking up. And the people who are building wealth aren't the ones earning 2 lakh rupees a month. They're the ones who hit 5 lakh rupees, understood the power of compounding, and stuck with it. Let me give you a real example with corrected math. There are two people. Person A starts investing at 25, reaches 5 lakh rupees by 28, continues with 10,000 rupees monthly SIP. By 45, 17 years of 10,000 rupees SIP from age 28, they have approximately 1.04 crore rupees. Person B waits until 35 to start investing seriously, reaches 5 lakh rupees by 38, continues with the same 10,000 rupees monthly SIP. By 45, 7 years of 10,000 rupees SIP from age 38, they have approximately 24 lakh 60,000 rupees. Same discipline, same returns, different starting point. That 10-year head start created a 79 lakh 59,000 rupees difference, almost a crore difference. And look, I want to be honest here. These numbers are lower than what I initially calculated because I was using annual compounding instead of monthly, which actually underestimated the power of regular monthly investing. But even with the corrected math, the point stands. Starting early makes a massive difference. This isn't about being rich or poor. This is about understanding that the first 5 lakh rupees is the hardest because you're building the habit, the discipline, the mindset. After that, it's just mathematics and patience. And here's something that's going to blow your mind. According to recent industry reports, India now has over 26.63 crore mutual fund folios or accounts, but only about 5.8 crore unique investors. That means most people have multiple accounts but aren't actually investing systematically. The wealth transfer I'm talking about isn't happening from old to young or from rich to poor. It's happening from the financially uneducated to the financially disciplined. And the dividing line, it's right around that 5 lakh rupees mark where people either commit to the long-term game or give up.
Okay, so if you're watching this and thinking, Rohan, this all sounds great, but I'm nowhere near 5 lakh rupees yet. Let me show you how to get there faster than you think. First, let's do some realistic math. Let's say you're starting from zero today. Here's your roadmap. Month 1 to 6, the foundation. Start with whatever you can afford. The current Indian average is 3,127 rupees per month according to January 2026 data, but even 2,500 rupees works. Don't think about returns yet. Think about building the habit. Set up auto debit. Treat it like a bill you can't skip. Month 7 to 12, the acceleration. Look for one-time additions. Tax refund, annual bonus, festival bonus, don't spend it. Dump it into your investment account. A single 40,000 rupees bonus invested properly can become approximately 1,24,000 rupees in 10 years at 12% returns. Year 2 to 3, the multiplier effect. This is where most people fail. They get comfortable with their SIP and never increase it. Don't be that person. Every 6 months, increase your SIP by 500 to 1000 rupees. It's not painful because your salary is also increasing. But compound that tiny increase over 3 years and you will be shocked. Here's a real calculation with monthly compounding. Year 1, 2,500 rupees monthly equals 30,000 rupees invested. Year 2, 3,500 rupees monthly equals 42,000 rupees invested. You stepped up twice by 500 rupees each. Year 3, 4,500 rupees monthly equals 54,000 rupees invested. Total over 3 years, 1,26,000 rupees principal invested. At 12% returns with monthly compounding, you'll have approximately 1,47,348 rupees after 3 years, almost 1.5 lakh rupees. You're 30% of the way to 5 lakh rupees. Continue this pattern for 2 more years with gradual increases and you'll hit 5 lakh rupees by year 5 to 6, not 17 years. The secret weapon, windfalls. Most people blow their windfalls. Salary increment, new phone. Bonus, trip to Goa. I'm not saying don't enjoy life, I'm saying be strategic. Rule of thumb, 50% of any windfall goes to investments immediately. The other 50%, do whatever you want. This single rule can cut your path to 5 lakh rupees by 2 to 3 years. Let's say over 5 years you get 2 bonuses of 40,000 rupees each equals 80,000 rupees, 1 tax refund of 15,000 rupees, 1 freelance project payment of 30,000 rupees. Total 1,25,000 rupees. 50% of that, 62,500 rupees invested at the right time can be the difference between hitting 5 lakh rupees in year 5 versus year 7. Look, here's what I want you to understand. The journey to 5 lakh rupees is not about the money. It's about becoming the kind of person who can handle wealth. Because here's the truth, and this is going to sound harsh, but most people who suddenly come into money, inheritance, lottery, whatever, lose it within a few years. Why? Because they never built the mental and emotional framework to handle that amount of money. But when you save your way to 5 lakh rupees, you've proven something to yourself. You've proven you can delay gratification. You've proven you can stick to a plan. You've proven you can handle seeing your portfolio drop 10% and not panic. That's worth more than the 5 lakh rupees itself. In January 2026, when equity fund inflows dropped 14% month over month, most SIP investors didn't stop. They kept going. That's the mindset. That's what separates temporary success from long-term wealth. And here's something I find fascinating. Talk to anyone who's built significant wealth. I'm talking 1 crore rupees plus, 5 crore rupees plus, 10 crore rupees plus, and ask them what their most important financial milestone was. Almost everyone will tell you it wasn't hitting their first crore, it was hitting their first 5 lakh rupees. Why? Because that's when they believed it was possible. Before that, it was abstract. After that, it was just mathematics and time. So let me bring this all together. Here's what we covered. Most Indians will never save 5 lakh rupees, not because they can't, but because they don't understand the game. The psychological shift at 5 lakh rupees is more important than the number itself. With proper monthly compounding at 12% returns, your first 5 lakh rupees plus consistent 10,000 rupees SIPs can become 1.53 crore rupees in 20 years. The 3 moves, split into buckets, commit to step up SIPs, kill your anchoring bias. Starting 10 years earlier creates almost 80 lakh rupees difference. That's the power of time. You can hit 5 lakh rupees in 5 to 6 years with a strategic approach to increments and windfalls. Look, I know this video was long and I had to correct some of my own math from earlier because monthly compounding on SIPs is more powerful than simple annual compounding. But here's the thing. In February 2026, we're living through one of the most incredible wealth building opportunities in Indian history. The mutual fund industry is at 81 lakh crore rupees. Over 9.92 crore Indians are already doing SIPs. The infrastructure is there. The data is clear. The opportunities are massive. The only question is, are you going to be in the 6% who build serious wealth or the 94% who keep making excuses? If you're serious about this, here's what you do today. Open a mutual fund account if you haven't already, start a SIP, aim for at least 3,000 to 3,500 rupees based on the current average, set a reminder to review and increase it every 6 months, stop checking your portfolio daily. That's it. That's the formula. It's not sexy, it's not complicated, but it works. And the math doesn't lie, though make sure you're using the right math with monthly compounding. And if this video helped you understand why 5 lakh rupees is such a crucial milestone, do me a favor, hit that like button and drop a comment telling me where you are in your journey. Are you at 50,000 rupees, 2 lakh rupees, already past 5 lakh rupees? I read every comment and I'll reply to as many as I can. Remember, the first 5 lakh rupees is about building the person who can handle wealth. Everything after that is just compounding. See you in the next one.